Welcome back to the Deep Dive. It is Thursday, January 29th, 2026. And if you've been glued to the financial tickers this morning, you probably saw the flash regarding Dow, one of the absolute titans of the chemical industry. I mean, a company that basically makes the fundamental ingredients for the modern world, just dropped their Q4 earnings. And honestly, if you just glance at the stock price or the headline number, you might miss the actual story here.
That is exactly right. The numbers themselves are, let's call them a mixed bag, to be polite about it.
Yeah.
But the real story isn't about a single quarter's beat or miss. It's about a massive industrial giant that is, fundamentally changing its shape right before our eyes.
So we've combed through everything, the earnings report, the slide deck, the full transcript of the call with the CEO, Jim Fitterling, and CFO, Jeff Tate, to really get to the bottom of this. And honestly, the theme here seems to be, well, tension. We're seeing this massive pivot to AI.
Right.
Significant layoffs, and a major delay to a flagship green energy project.
Yeah.
It's a company trying to, and this is their term, shrink to grow.
Well, management's using another specific phrase for it, self-help.
Which sounds a bit like Dow is heading to therapy.
In a corporate sense, they are. And the mission of this deep dive is to unpack exactly how a company of this size tries to fix itself when the global economy isn't doing it any favors. When demand is low and pricing is tough, you can't just wait for the world to change. You have to look inward. You have to fix yourself because the market isn't going to save you.
Okay, before we get into the therapy session, though, we need to set the table with the raw data. Let's just get the medicine out of the way. What was the headline number everyone is reacting to?
So for the fourth quarter of 2025, Dow posted an operating loss per share of 34 cents.
A loss. Okay, that sounds bad.
It is a loss, yes. But, and this is the classic Wall Street expectations game, that was actually significantly better than expected. Analysts were bracing for a loss of 46 cents, so they beat expectations by 12 cents.
So a less bad loss than feared.
Precisely. It's all relative. On the revenue side, they brought in $9.46 billion. That was a slight miss, down about $20 million from estimates, and down about 9% compared to this time last year. So the business is smaller, and on an operating basis, it's losing money right now.
Which sets the stage perfectly for the big strategic announcement. Because usually when you're shrinking and losing money, you don't just say, well, hope it gets better next quarter. You announce a plan. And they launched a new program with a very rhyme-heavy corporate name, Transform to Outperform.
It does sound like a motivational poster you'd see in a break room, doesn't it? But the details underneath are actually quite gritty and, frankly, quite aggressive.
Let's dig into that. What's the actual financial goal of Transform to Outperform?
The target is to increase EBITDA by at least $2 billion in the near term.
Okay, for the listener who might hear that acronym thrown around a lot, EBITDA, why is that the metric they're chasing?
Sure. It stands for earnings before interest, taxes, depreciation, and amortization. It's basically a way to measure the raw operating profitability of a company, stripping out accounting decisions in tax environments. It's the purest way to see if the core business making chemicals and selling them is actually generating cash.
So they want to find an extra $2 billion of that raw profit.
Mm-hmm.
That is not chump change. Where are they finding it?
2 places. They say about 1/3 will come from growth, so selling more stuff. But the other 2/3, that's coming from productivity.
And in the corporate dictionary, productivity usually translates to
Cost cutting. And this is where the human cost comes into focus. To get that productivity, Dow announced a global workforce reduction of approximately 4,500 roles.
Yeah, 4,500 people. That is a heavy number.
It's significant. And I think it's important we pause there because it reflects just how much pressure these industrial giants are under. But what's fascinating, and where this connects to the broader tech trends we've been tracking, is how they plan to do it. They aren't just saying we're slashing budgets. They are explicitly tying this to AI and automation.
This is the part that really jumped out at me. CEO Jim Fitterling called it a rewiring of the way they do business. It feels like we've been hearing about the AI revolution for a few years now, but mostly in tech companies or creative fields. This feels like the rubber actually meeting the road in heavy industry.
It really is. They're talking about structural reengineering. They want to streamline end-to-end processes and, importantly, reduce management layers.
So flattening the hierarchy.
Yes. They're using automation to handle tasks that used to require human intervention, specifically aiming to reduce bureaucracy. It's not just about doing the same work with fewer people, it's about using technology to change the work itself, so those middle management roles just aren't needed.
That's a crucial distinction. It's not just do more with less. It's let the machine do the organizing.
Yeah.
But this transition isn't free, right? You have to spend money to build those systems and, frankly, to pay the severance for the people you're letting go.
Correct. They were very transparent about that. This transformation is going to cost them between $1.1 billion and $1.5 billion in one-time costs.
That's a massive upfront bill.
It is, but they expect about $500 million in benefits and savings to start showing up this year in 2026. It's the classic shrink-to-grow strategy. You take a hit now, you pay the upfront cost to become leaner and more profitable later.
So that's the internal shakeup. They are rewiring the house. But there was another massive piece of news that affects the bigger picture, especially for anyone following the green energy transition, the Path to Zero project.
Right. This is the massive project in Fort Saskatchewan, Alberta. It's Dow's net zero ethylene cracker. Basically, it's the crown jewel of their sustainability strategy. The idea is to make the plastics we need without the carbon footprint.
And the news is, it's going to be late.
Significantly late. They've shifted the timeline for Phase 1 startup by 2 years, pushing it to late 2029.
2 years is a lifetime in this industry. Why the delay? Is the technology not working?
No, it's not a tech issue at all. It's purely an economic one. If you listen to the management team, it's about reading the room, or rather reading the global economy. They argue there's no point in bringing massive new supply online when demand is still soft.
So why build a factory to make stuff that nobody wants to buy yet?
Exactly. Plus, there's the cash preservation aspect. When earnings are in a trough, as they are now, you want to slow down your capital spending, your CapEx.
Yeah.
You don't want to be burning cash on construction when your core business isn't generating a ton of profit.
That makes sense financially, but I have to ask about the viability of the project. Does delaying it make it less profitable? I mean, time is money, right?
That's the tricky part. And technically, yes, it hurts the returns. Management revised the expected returns on the project down to 8 to 10%.
8 to 10%, that seems modest. Why did it drop?
It's due to something called capitalized interest.
Okay, help us out here. What does that mean in plain English?
Think of it like this. You're building a house with a construction loan. If you pause construction for 2 years or slow it way down, you're still paying interest on the money you borrowed to buy the lumber and pour the foundation. But you can't move in, so you're not saving on rent yet. That interest just keeps piling up and gets added to the total cost of the house. So effectively, the house gets more expensive to build, which lowers your return on investment.
That's a great analogy. So the price tag goes up because the clock is just ticking.
Exactly. However, and here's the silver lining they kept pointing to, that 8 to 10% return is just the base model. It doesn't include what they call low carbon premiums.
The extra money customers might pay for green plastic.
Right. They believe that big brands, think of your massive consumer goods companies that have promised to cut emissions, will be willing to pay more for materials that help them hit those targets. Dow thinks that could add another 100 to 200 basis points to the return.
Just a quick check basis points.
Though the bankers speak, 100 basis points is 1%, so they think the green premium could boost the return by another 1 to 2%, getting them back into double digits.
So if the market is willing to pay up for green tech, the project still looks good.
That's the bet. And for what it's worth, they said the detailed engineering is mostly done. They're buying the heavy equipment now, so they aren't canceling it. They're just hitting the pause button on the heavy construction labor to save cash right now.
It sounds like they're trying to build a fortress around their balance sheet while they wait for the economy to turn.
Financial fortress is actually a term they love to use, and for good reason. You have to look at their cash position. They ended 2025 with $3.8 billion in cash on hand.
That's a lot of dry powder.
It is. And if you look at their total liquidity, it's about $14 billion, but they didn't get there by accident. To build that fortress, they had to make some really tough calls over the last year.
I seem to remember they cut the dividend, right? Which is usually a sacred cow for these old industrial companies.
It usually is, but they slashed it by 50%. That's painful for shareholders who rely on that income, pension funds, retirees, but it saves the company a tremendous amount of cash. They also cut their CapEx by $1 billion in 2025.
And they sold off some assets, too.
A huge deal with Macquarie Group. They sold a 49% equity stake in some of their Gulf Coast infrastructure. That brought in about $3 billion.
I want to understand that deal better. Selling a 49% stake.
Yeah.
So they kept control.
Yes. It's like owning a house and selling 49% of it to a roommate. You still decide what color to paint the walls and you keep the master bedroom, but the roommate gave you a big chunk of cash up front, Dow still operates the assets, they just unlocked the value tied up in them.
So selling the furniture to pay the mortgage.
Or maybe renting out the spare room. The result is that they have no major debt maturities until 2029. They've bought themselves a runway.
Survival mode.
Or strategic flexibility, as they'd call it. They are protecting their investment-grade credit rating at all costs. In this environment, having access to cheap borrowing is vital.
Okay, let's pivot from the high-level strategy to the actual nuts and bolts of the business. Because Dow makes a lot of different stuff that goes into everything from milk jugs to iPhones. What's happening in the segments?
Let's start with the big one. Packaging and specialty plastics. This is the engine room. Sales were down 11% year over year.
Ouch. Is that because people are buying less plastic?
Actually, no, and this is the interesting nuance. Volume was actually up sequentially in polyethylene. People are buying the stuff. The problem is the price. Prices are down significantly.
So they're moving more product but getting paid less for it.
Exactly. It's a deflationary environment for them. And Europe remains a real problem child. They actually had to idle a cracker in the Netherlands because the economics just didn't work.
Europe just seems incredibly tough for industrial manufacturing right now, between energy costs and regulation.
It's a perfect storm there. But on the flip side, their new Poly 7 train in the U.S. Gulf Coast is up and running. That's a low-cost asset running on cheap American natural gas, so that helps offset the pain in Europe.
What about the industrial side, the chemicals that go into construction and factories?
That falls under industrial intermediates and infrastructure. Sales there were down 9%. And the culprit's pretty clear: the housing market.
Construction is still slow?
Very slow. If people aren't building houses, they aren't buying the chemicals that go into insulation, pipes, and wiring. But there is one weird bright spot in the report: de-icing fluids.
De-icing fluids, like for airplanes and roads.
Yes. Bad weather is good business for Dow sometimes. The winter storms boosted sales there.
I guess there's a silver lining to freezing your toes off.
I suppose so. But there's a darker cloud hanging over this segment, too. Sadara.
That's their massive joint venture with Aramco in Saudi Arabia, right?
It's been a drag on earnings, and now it's officially under strategic review.
Which, in corporate speak, usually means we need to fix this, sell it, or change how we own it.
Almost always. They expect to finish that review in the first half of this year, so watch this space.
Okay, and the last segment, coatings.
Performance materials and coatings. Sales down 6%. Again, architectural coatings paint for houses is down because housing is down. But there's a fascinating divergence here. While housing is weak, demand for electronics and mobility like EVs is actually holding up well.
So we aren't painting the house, but we are buying a new phone or an electric car.
Precisely. It tells you a lot about where the consumer's head is at. And in this segment, Dow is also ruthlessly cutting high-cost assets. They announced they're shutting down a siloxanes plant in the UK by mid-2026.
It really is a theme across the board. If it's expensive to run, shut it down. If it's efficient, run it hard.
That is the self-help strategy in a nutshell. Don't carry any dead weight.
So if we zoom out, Dow sees everything. They sell into almost every part of the economy. What are they seeing in the crystal ball for 2026? Are things getting better?
It's cautious, very cautious. But CFO Jeff Tate used a phrase that optimists love: green shoots.
Green shoots in housing.
Yes. He noted that existing home sales have increased for 4 months in a row. He thinks the interest rate cuts are finally starting to gain traction.
It takes a while for those rate cuts to filter down to a mortgage payment, but maybe we're finally seeing it. What about the consumer? Are we still spending?
Confidence is low. People say they are worried. But retail spending is holding steady, specifically in electronics, so we're worried, but we're still buying gadgets.
And energy. I know that's a huge input cost for them.
Dow feels good about their position in the Americas. Natural gas and ethane costs are low here compared to the rest of the world. There was a spike recently due to the freeze-offs, the cold weather impacting production, but they view that as temporary. They think the U.S. remains a huge competitive advantage for them.
So let's try to pull all these threads together. We have a company that is basically clearing the decks.
That's the best way to put it. They aren't trying to fight the current, they are reinforcing the boat.
They're cutting 4,500 jobs to replace them with AI and automation, changing the very structure of the company. They are delaying their massive green project to save cash. They've sold assets, cut dividends, and are shutting down expensive plants in Europe.
All to be ready for when the cycle turns. They are betting that when the economy finally picks up, maybe later in 2026 or 2027, they will be leaner, faster, and much more profitable.
The Transform to Outperform program is really the thing to watch here. It's a bold claim to say you can cut that many people and actually grow faster.
It's the $2 billion question, can they execute? Because there is a risk here. If you cut too deep, you risk damaging the company's culture and its ability to innovate. Automation is great, but it doesn't invent the next breakthrough plastic.
Right. You can optimize yourself into a corner if you aren't careful.
Exactly. But if they get it right, if the AI integration works, they become a much more efficient machine.
And that leads me to a thought I want to leave our listeners with. And it goes back to that path to zero delay.
The 2029 delay for the green cracker?
Yes. Dow is delaying its big green project because it makes financial sense today. It saves cash. And I'm sure they aren't the only ones. We're seeing this across the industry companies pulling back on capital spending because rates are high and demand is low.
Right. Cash is king right now. You survive today to fight tomorrow.
But here's the provocative question. The world has these massive climate targets for 2030. If every major industrial player delays their green projects by 2 or 3 years to save cash in 2026, are we setting ourselves up for a massive supply shortage of green materials right when we need them most?
That is a massive risk. We call it a green bottleneck. Financial discipline today could mean we simply don't have the materials to meet the 2030 goals.
And if that happens, basic economics kicks in. Low supply, high demand. Those green premiums Dow is hoping for. They might end up being a lot higher than anyone expects.
It's a fascinating tension between short-term survival and long-term transition. Dow is playing the long game, but the timeline just got a little longer.
Something to chew on. That's it for this deep dive into Dow's inflection point. Thanks for listening, and we'll catch you on the next one.